Last year represented a watershed moment for climate awareness and action. COP26 is still very fresh in the memory of most mining executives, and as pressure mounts to meaningfully align with the 1.5 degrees warming scenario, decarbonisation stands out as a key value driver. This has strengthened our view that the mining industry now has a clear pathway towards long-term transformative demand encapsulated by the energy transition. This presents a fascinating dynamic to sector players, and we expect capital allocation will shift further to take advantage of the much-anticipated supercycle in green energy materials. In response to these unstoppable trends facing the industry, Mackenzie acquired Roskill in Q3 last year. We are pleased to announce that we have completed the integration of Roskill's products, and together with our existing suite, now offer unparalleled coverage of the metals and mining industry.
I think you'd have to be living under a rock not to realise that prices have been extraordinarily strong, and have exploded into 2022 after a very solid 2021, and that's what we're showing here in the left-hand chart. Essentially now we've got base metals at somewhere between 30 and 60% above where they were pre-pandemic. For battery raw materials, it's more like 300%, 500% above where they are, and even bulks have been joining the party at 2.5 to 3.5 times where they were. Obviously, that has created enormous margins, and we're illustrating those on the right-hand side, particularly current spot prices, which are shown with the green dots. But of course, last year's margins on average, shown in the bars, were also very, very solid. Typically, we look at the 90th centile of cost curves to give us an indication of where long-term sustainable price support might lie. And obviously, prices are way above that 90th centile, much higher than incentive price levels as well. And for some market participants, they see this as the sign that the energy transition supercycle has arrived. It's here, fully fledged and flying, and that we could see markets continue to have disruption and be in deficit from here to 2030, 2040 and beyond. So structural deficits. We think that's probably premature. I mean, one of the things we look at is the margins that the bulks are seeing at the moment, which we know has been partly caused by a lot of issues other than the energy transition effect on demand. And when we look at where we think markets will trend from a balance perspective over the next 24 months or so, in most cases, the markets we think will be less tight than they are today. Now, it doesn't mean they're going to jump into a massive surplus, of course, but on the whole, we are expecting supply-demand balances to improve. There are some exceptions, aluminium and zinc next year, which we think is going to be a struggle from a supply perspective because of power price issues, particularly in Europe and China. But on the whole, things we think will improve. And when we actually look at where prices are today, we think that there are a bunch of very unique circumstances that are playing a role on top of undoubtedly the energy transition premium that is being paid. And there's things like the pent-up demand from the pandemic, hugely stimulated economy, a lot of restocking, some hoarding, but particularly supply chain issues which have lingered even whilst the economic recovery has taken hold. And that has really supercharged pricing and is a very important part of why we're seeing prices where they are. So super cycle, yes, but not quite. When you look beyond 2023 and you look to 2030, for instance, those sort of structural demand issues relating to the energy transition really start to have an effect. And apologies for the amount of information on this page. I guess what I would say as a major message from this slide is that apart from iron ore and thermal coal, really there are very, very positive demand outlooks across the metals and mining space. The Chinese structural change in the steel sector, that slowdown that will occur, and of course the power sector transition, which is already underway, are really doing for thermal coal and iron ore. But across base metals, battery raw materials, rare earths, there really is universal growth. And of course, in volume terms, that growth is, in absolute volume terms, it is much smaller than the kind of changes we might expect to see in bulks. But when you look at it in terms of the size of the market, which is more important, I guess, from an investment perspective, the changes are really, really quite exciting. And that's what we're showing on the right-hand chart. The types of growth we're going to see to 2030, we think, are sort of 15% for lead zinc, about 20% for copper and aluminium, just below 40% for nickel, and then 70 or 80% for the rare earths and cobalt, graphite, and essentially a tripling of the lithium market. Now, that kind of growth, we think, is going to create some major challenges for miners, remembering that this is under our base case. Certainly, we don't think there are enough committed projects in the pipeline to actually meet the demand that I just laid out. And this chart is just showing the kind of gap that we are seeing in respect of the existing market size. And so we're talking some big numbers. We're talking 5 million tonnes of aluminium, that additional commitments need to be made, 5 million tonnes for copper, 400,000 tonnes for lithium, and 40,000 tonnes for cobalt. So really quite significant. It doesn't mean that this supply gap will exist in 2030. I guess what we're saying is that investment needs to ramp up, and we're looking at about $200 billion of additional investment that would get us to where we need to be. Reticence is understandable from an investment perspective. These markets are very volatile. They're uncertain, particularly those that are influenced heavily by China. And so we can understand that miners may not wish to dive in with both feet, but something has to change, because we are in 2022 and 2030 is really just around the corner, and particularly when it takes typically 7 to 10 years to bring on new greenfield supply. And of course, I'm talking about the base case, and the base case emissions trajectory is just shown in this chart in the grey line. And it's consistent with a 2.5 to 2.7 degree global warming. It basically means flat emissions to 2030 and then a modest reduction. One of the things you'll notice is that there is a yawning gap between our base case and the 1.5 degree and 2 degree Paris targets in the orange and blue lines. COP26 made progress. The pledges would push us to just below 2 degree, but of course most of those pledges came with zero backup in terms of binding legislation or major policies in a lot of cases. Under the 1.5 degree, you need to actually go net negative in terms of energy emissions by 2050, and you're looking at about 25% reduction in emissions by 2030. Now, that does extraordinary things to the supply requirement, and this chart's just trying to show the additional commitments that are required under both base case and AET 1.5. And for instance, you really double the extra investment you need in aluminium. So you go from 5 to 10 million, copper's 5 to 9 million, nickel's an extra 1.7 million tonnes. So enormous, and obviously lithium and cobalt need tripling, quadrupling of those supply markets under this case. And of course, under this AET 1.5 trajectory, it's where future-facing commodities really come into their own. The investment requirement to get to this point, we think, is going to be over $400 billion.